Managing Director Ali McCartney, whose wealth management team's year-end S&P target is 5,200, with an ultimate, we got to put this in, Goldilocks target of 5,500. That would be under perfect circumstances. And Pence Wealth Management's Dryden Pence, who right now says buy Apple. All right, Dryden, we'll get to you in a minute. I first want to turn to Ali.
Sure.
Ali, bond yields are jumping. The stock market is up. Even last week's reveal of February retail sales missed. So we start to see a few hair stick fractures, or green stick fractures, as they call them, in the labor market and elsewhere. What is your outlook? You're at 5,200 while some of the others on the street are at 5,400.
Yeah, so even our investment bank is actually at 5,400. What you're starting to see is the market and the Fed coming together, right? So at the beginning of the year, we had a market that was expecting 160 basis points in cuts. The Fed was telling us through their dot plot that they were anticipating 3 and wanted to be cautious. Those two things have now come together. And when you take all of the ups and downs of data, a lot of which you pointed to, markets are trying to figure out whether this is a wait and see for the Fed, or whether to go forward on earnings, which look great, or to be concerned about some of the cracks that you're finally starting to see after the quickest, deepest hiking cycle ever.
It's not that you guys are totally bearish on stocks at all. You like stocks, but you're also saying lock in longer-term Treasury yields. And this is at a point where we're seeing the 2-year, the 3-year, the 5-year, 10-year, they're continuing to move higher on these yields. You still stand by that?
Exactly. So that's what we were talking about coming into the show, right, is that it's really hard to incent people out of short-term yields right now. But as you start to see the market and the Fed expectations come together, what you're seeing is you know that rates are going to go the other way. They're not going to go the other way as quickly or as deeply, but that opportunity to lock in, let's say, 4 to 7 year yields at this level is not going to be here forever. So we want to see people getting into stocks. The rally is broadening beyond the Magnificent Seven, and we want to see people diversifying because, by the way, diversification is back. It's working.
Okay, but today, Dryden, you do have the Mag 7 stocks looking very robust, particularly Apple and Google. You coming into today were saying buy Apple. Now, I know you're bullish there. It's not because of this, I believe, this Gemini deal, because this is not even a deal. It's just a rumor. But you say that Apple is troughing or getting close to the bottom after having had a somewhat weak year to date compared to the other names. Is that behind your whole thesis that simply it's troughing?
Well, I mean, the fact of the matter is that, you know, because of a lot of concerns for China and things like that, people kind of pull back on Apple. It has kind of gone down. It's down. It was the biggest drag on the S&P for the year. But when you tear apart the fundamentals, you recognize that Apple is a tremendously large company with a tremendously large ecosystem. And as you begin to see the economy continue to be robust, it's going to benefit from that. I mean, if you just look at the App Store alone, that is a $1.1 trillion ecosystem. That's as big as the entire GDP of the Netherlands, the 18th largest country in the world. And so if you think about Apple as an enterprise, as an ecosystem, as everything, as the economy gets better, they're going to benefit from every part of it. So it doesn't necessarily justify the fact that it's been pulled down. I mean, if you have as many people, 2.2 billion people, using the system, and all those devices are more than you have people in China.
Can I just throw this out at you, though? Their China business,
the large piece of this.
Their China business, though, is down significantly, Dryden, and not to mention that the Vision Pro, I mean, I don't know if that was ever a real thing in their minds, that it would be some type of blockbuster product, but where's the buzz on that several months after it launched?
Well, I think that you can't say that it's been a perfect launch, but it takes some time for the product to catch on. And we've seen this before with Apple. Sometimes it took a little while for things to take off, and then once they finally did, is they got a broader spectrum in it. So I think that again, we believe that Apple is the largest and greatest consumer products company that's out there, and consumers have money, and they're continuing to spend it on their products. So we think long term, you're at kind of this J curve of this growth that we see going forward.
Ali, you could argue that the core equity play has been tech, but now you say broaden that out. I keep hearing that, and yet much of the gains that we've seen so far have really been driven by the Mag 7. So, you know, you want to be a little bit putting the horse before the cart in the smaller caps and mid caps?
So first of all, we have two things that are leaning into the small caps and mid caps. First, and this is value as well, actually. First, you have historical underperformance relative to their counterparts. The second is, especially when you look at small and mid caps, the majority of debt for those companies is floating rate debt. So if you anticipate a multiples effect in the market based on interest rates coming down, then you would also expect that to decrease the cost of debt for some of these companies, which would make them more profitable. And remember that in addition to multiples, which has been sort of the expansionary factor in, you know, the last number of years, now we're talking about an earnings recession behind us and real earnings growth. We think 9% this year and 6% next year that are going to take a lot of rising tides up. Now, the one thing that I will say is, so last week, when we had our 17th new high for the S&P in this cycle, we also had a historical high for the equal weight. So that story is real. We are so, I think, clouded and focused on AI and the Mag 7, we sometimes don't understand what's going on under the hood.
You upgrade healthcare and industrials, and you downgrade consumer staples and energy.
Yes.
Why?
Now, the energy trade has actually worked against us in the short term with what has happened in the energy market over the last 2 weeks. In terms of industrials, think about all the secular trends that were started by the pandemic. Onshoring, more geopolitical risks, so defensive spending. It's also one of the widest sectors in terms of what it covers. And then when you talk about downgrading energy, think of the geopolitical risk associated right now across the world with energy.
Yeah.
Now, as a counter to that, though, we have the exact conversation we're having today, which is what fuels AI? What fuels cryptocurrency? Well, that's more energy and more semiconductors, which is sort of the story of some of the names we've been talking about.
Dryden, you point to what has been a good earnings season. We're almost at the tail end, but I would remark that Wednesday and Thursday, we get some very big names. Wednesday, I know that we are getting General Mills, Micron. Thursday, FedEx, Nike, Lululemon. When you look at some of these names, do they have the opportunity to propel the markets? And are they big enough for that? I mean, I would think Micro and Nike certainly in their sectors. You know, at the same time, we've got strategists warning that when investors in risk assets have a devil-may-care attitude and you pair solid companies and their moves to something like the record highs in gold and Bitcoin over and over again over the last couple of months, how do you square that with your investment entire pie?
Well, I think that we're going to focus on fundamentals. Sometimes things get ahead of themselves. But when you take a look at fundamentals across the board, companies are, we have a majority of the companies beating. We're beginning to see the broadening out of the 473. The fundamentals are strong. So we're excited about taking a look at this positive data going forward, because we think that first quarter and second quarter, you're going to see this broadening out, and the fundamentals are coming in, and earnings are coming in, and earnings are continuing to grow. So we're excited about it from that standpoint. Sure, folks can get ahead of themselves in some of the high flyers, but when you take a look at the market in and of itself and the economy of itself, we think that we're positive around all of these, and that's what we're going to look at.
You know, if we could just freeze it here, markets higher. We have obviously some pretty solid data coming through, and I don't know, that looks like a Goldilocks scenario, at least in a way. We shall see. Good to see you both. Ali McCartney, Dryden, Pence. Thank you.